Hello?
You need to press.
Hello?
You can't hear you.
You can hear me? I don't think so. Hello? Can anyone hear me? There we go. Good morning, everyone. Thank you for being here, and pleasure to have this conversation. My name is Hetal Patel. I'm Director of Investments with Mercy Corps Ventures. I'll be moderating this conversation, but mainly really kind of unlocking a great conversation between my excellent panelists. We'll let them introduce themselves as they deal with the first question. But overall, I think the base where we're really here and what we really want to discuss is around the nexus of returns and impact for climate investing. Specifically, when we're talking about climate investing in this context, we're looking at climate adaptation and resilience investing. We at Mercy Corps really are grounded in the belief that we're not making trade-offs between what the market may need and impact, but actually this is a massive market opportunity. Some of the research shows that adaptation and the money that needs to flow, but the market itself will be a true $2 trillion opportunity, and much of it is really around the global south and the global majority. So really trying to have a robust conversation to understand how these different funds approach their thesis, the types of businesses they're looking for, and what that really means for impact and the returns they project. And a lot of conversations today are happening around the capital that's flowing to the continent. What does capital preservation mean for businesses and the business models and the founders who are running it? So that's the kind of conversation we're really trying to unlock. And I'm going to start with Rachel, actually. So I think we talked a bit about last week as we were thinking about this panel about DRK's approach to their thesis. And it's a bit different than the other panels, so we'll start there and then we'll let the other panels talk about it.
Absolutely. Thanks so much, Hetal. So, hello everyone. My name is Rachel. I'm a principal at the Draper Richards Kaplan Foundation. We are impact-first investors and what we call venture capitalists. So we truly do fundamentally believe that impact and returns don't necessarily have to be separate. We are catalytic capital providers, generally sector agnostic, but at the core of our thesis is ultimately we want to invest in ideas and founders that are solving some of the world's most complex problems. So for us, at the core of our thesis is looking for solutions that are highly scalable, have evidence of impact, have sustainable business models, but are impacting in a positive way marginalized or underserved communities.
Thanks, Rachel. I'm going to jump to Scott, actually. And while I know a lot about our thesis, I think there's a lot to share with the room in terms of our approach, the thesis, and the types of things we're looking for.
Great. So yeah, thanks, Hetal. So hello, everyone. I'm Scott Onder. I'm the Chief Investment Officer for Mercy Corps, where I lead our global strategy for impact investing and innovative finance. And I'm also the co-founder and managing director of Mercy Corps Ventures, which is an impact venture capital fund that's invested in 50 companies that are developing climate adaptation and resilient solutions. They've scaled now to reach over 80 countries and 25 million users. And our investment thesis within Mercy Corps Ventures is really focused on 3 key areas around climate adaptation. So we're very interested in climate smart technologies, deep tech, solutions such as tropical weather forecasting models, solutions that leverage data analytics and advanced AI, solutions like flood data analytics companies. We invest in sustainable supply chain solutions, e-mobility, nature-based solutions, and carbon credit market infrastructure. We also invest in inclusive fintech, solutions like digital savings, embedded credit, insurance that helps transfer and manage climate-related risks. And then we're also investing in adaptive agriculture solutions such as precision agriculture, regenerative agriculture, that helps strengthen the resilience of smallholder farmers and the food systems they operate in. Excited to join the conversation today.
Thanks, Scott. I'm going to jump to Muthoni and how you're envisioning the approach for the Ag and Climate Fund of Katapult.
Thank you. Is this on? Hello. Oh, perfect. Good morning. My name is Muthoni, Wachira, and happy Valentine's Day. I am the managing partner for Katapult Africa Food and Climate Fund. Katapult Africa Food and Climate Fund is part of the Katapult group of funds. We have 14 funds under management, 100 million assets under management, four exits and 2 unicorns in our portfolio, 169 startups invested in since 2017. For the Africa Fund, we're looking at the intersection of agriculture and climate, looking at the supply chain, sustainable food production, efficient supply chains and infrastructure, inclusive services, including insurtech, fintech, etc. We have a Pan-African focus for this $50 million fund. And we have a unique model where we invest and then accelerate all our startups. We're looking to invest in 60 startups with this fund and follow on at Series A into 12 of them.
Thanks, Muthoni, and we'll dive into some of those details in a bit. Oliver, I'm happy that you were able to join later, and because it's really interesting to hear a bit more about how the larger investor size and the later stages approach this.
Thanks. Hi, everyone. My name is Oliver Game. I'm lead for venture capital and private equity in East Africa for Proparco. Proparco is the French development finance institution. It's part of the French Development Agency group. So we're a bit different, I guess. Coming from a fund-of-fund angle and also as a direct investor, our role really is to structure the ecosystem. That's how we see it. We've been doing this on the VC front for close to a decade now. We've made 15 investments in venture capital funds on the continent. We've made 30 investments in startups on the continent. And what we tried to do all along is to accompany the gaps in the market and, fill the need which seems the most acute to us. And so it's very interesting for me to have this conversation today because I feel like this panel is kind of on the next frontier of what we're trying to achieve in this market, but we can talk more about it later.
Sure. So I think I'm going to come to you, Scott, because you were hitting some specifics earlier, but maybe we can get a little bit deeper around the types of climate models that are exciting the team and you're looking at in terms of just what's exciting, what's sector-wise exciting, but also then how that builds towards the next question, which is going to be around kind of portfolio construction.
Yeah, absolutely. So as Maelys and Juliet were just sharing in the prior keynote, I thought there was just a wonderful breakdown of the different sectors that make up adaptation and resilience from a climate perspective. And we've been really trying to go out at the cutting edge of emerging technologies to see how solutions like AI and data analytics, how blockchain and other emerging kind of fintech solutions can really drive climate solutions and resilience. And so in a few of the different areas where we're very focused that I would describe as more deep tech, we're seeing that data availability and the price of that coming down, the price and accessibility of AI and machine learning models like large language models is really spurring a revolution in climate adaptation solutions. From climate modeling to analyzing vast data sets, we're seeing that startups are now being able to plug in those solutions in a much more affordable way rather than having to have a massive data science department. And so wanted to give you some really concrete examples of what that looks like. We've invested in a company called Floodbase, which is a flood data analytics company, and they provide their platform to insurance companies, to reinsurance companies, to governments, to better assess, price, and respond to catastrophic flood risk. And that can be used for essentially designing and triggering parametric insurance policies. We're seeing a number of different companies in our portfolio actually that are utilizing geospatial data, remote sensing data, satellite imagery data, also using kind of AI and analytics to provide insurance policies in weather index insurance, in climate. One example of that is a company here in Nairobi, Pula, which is using weather index insurance, combining essentially remote sensing and on-the-ground data to provide insurance policies to farmers. We're also really interested in kind of the nexus of climate and how that's getting to users, especially in emerging markets. So we've invested in a company called Ignitia that's a AI-based tropical weather forecasting model, and they essentially deliver those real-time, hyper-local forecasts to users via mobile, helping communities become more responsive and resilient to climate shocks and stresses. We're also seeing in the supply chain space a number of really compelling solutions. We've invested in a company called Meridia that's a geospatial data company that is essentially working in agriculture supply chains to help monitor and track different supply chain exposures to things like deforestation, carbon offsets, and carbon footprints. In the wake of regulations within the EU, for instance, that data and those tools is becoming increasingly relevant. And then zooming a bit away from data and over to climate smart energy. In particular, we're excited about programmable distributed energy models that can lead to more productive uses. So there's actually a company here called Kofa that's in our portfolio that is developing a distributed battery charging network, starting with e-mobility as its first application, creating a more distributed, climate-proof, climate-resilient access to energy approach that we're excited about. And then lastly, wanted to also highlight the carbon credit markets have been coming up a few times in the prior conversations. We really believe that the infrastructure around carbon credit markets and nature-based solutions is at a turning point. So we're seeing solutions like digital monitoring, reporting, and verification solutions really becoming more affordable for project developers in emerging markets to be able to utilize for nature-based solutions and carbon offset projects. A company in our portfolio that's doing that is called Open Forest Protocol, so they're doing it with both forestation projects as well as agriculture and agroforestry. So just wanted to kind of share a few of those examples, but maybe I'll pause there.
Sure, thanks, Scott. Muthoni, I'm going to jump to you, given that some of those may align with what you're looking at. So how do you think about some of the examples that Scott gave? What may be different for your construction? But also, how do you think about what the scale may be for some of the models you're looking at as you're thinking about pipeline for this fund?
What the scale may be?
For some of these business models that you may be thinking about for this, as you think about pipeline for this new fund.
Okay, so better. I would say when we think about the opportunities in the market, we see a protection gap for those living at the base of the pyramid. So it could be smallholder farmers, it could be the gig workers who are working in farms, and it's generally majority women. So we care about the nexus of climate and gender. And we actually have a company in our portfolio which was a first LATAM unicorn. We invested in it, female-founded, looking at insurtech space. And 2.5 years later, it got to unicorn status. So there is opportunity to address the protection gap. We see opportunity also on the supply chain side. So if you look at the amount of food that's produced and not eaten, it could feed 2 billion people. And that's more than the undernourished in the world. So we've seen business models trying to address that look different. On the biotech side, we have startups in our pipeline that are using biodegradable material to create protection for produce so that it has a longer shelf life. We've seen cooling as a service, solar-powered cooling as a service business models. We've seen access to market business models that are trying to get global buyers to access smallholder farmer produce. So that's an interesting part for us. We also have an ocean fund, so we look at wave technology, for example, as alternative energy sources. We are keen on bioplastics and creating efficiency there. We have a startup in our pipeline that's using genetically modified bioplastic. So that's interesting as a scalable model. And then let's see what else we have. Circular economy. So when it comes to waste management, recycling, and upcycling, it's also an interesting sector for us.
Thanks. Oliver, I'm going to jump to you for reflection from a potential investor who may be following on some of these models. So I think it's interesting for some of us to hear how you think about it. What would be the analysis of the lens that Proparco would take to some of these models in terms of where you'd want them to be, let's say if they're coming to you at Series A or Series B, especially in terms of where the financial viability is. Let's say, given a lot of these models do have clear impact potential, but I think there's going to be a lens that say, if that money is coming in, where does that growth go to?
Yeah, I think you're right. A lot of what we've done until now, as I was saying, was accompanying the ecosystem. So until now, that meant a lot of mitigation, not adaptation, right? It meant a load of asset-heavy businesses as opposed to purely tech-enabled businesses. And we feel like, so we supported funds in that space, and we also felt like we had a role to play as a direct investor. So on the direct side, we were back then looking for, when I say back then, it's not that long ago, but we was, even when you're talking about CNI businesses or mini grids or metro grids, we're looking to do this in a very additional way, and so typically in frontier markets, or literally building utilities in the DRC, things like that. So I think we have a role to play as a DFI in terms of providing capital and being a long-term, deep-pocketed investor for these sectors. But that doesn't mean we shouldn't be an early-stage investor either. And so we have this reputation, I think, as a late-stage investor. What we also seek to do now is we've been plugging gaps. So initially, when the market emerged, there was a lot of funds raising in the mid-market, and then they went on to raise successor funds, and so you get a concentration of capital. We want to avoid that concentration of capital. We've done it in the past with the likes of our investment in E3, and what we intend to do going forward is to accompany the likes of the people here in terms of funds which are pre-Series A, trying to find these new models. We shouldn't be purely talking in terms of clean tech, for example. There's as an isolated vertical, as you've all been describing, we should be considering ag tech, clean tech, fintech as very overlapping areas. That's what we're seeing right now. We want to support the guys who are plugging the gaps, and then we would like to plug into that ourselves in turn. And we'll do that with. So we invest from Series A to Series C with pretty small tickets actually for a DFI, which can start at 200K. But we can also we have some concessional-like instruments which allow us to come in pre-Series A, bridge rounds, give your companies some headroom to unlock the value they need and prove the points they need to prove prior to typical bigger funds coming in. And that's how we see our role.
Okay, I heard two things that I want to come to Rachel, but I had two things that may have a follow-up question or see if the panel want to jump to. It's a bit noisy, but I think I heard you mention fintech.
Yes, correct.
Yes, so I definitely want to see how the panel thinks about fintech and climate. I think that's an open discussion that happens a lot in the ecosystem, so maybe we could have that here, and I don't know if someone wants to take a lead on that. And then the other piece that is coming later is about the de-risking, which is some of the things you were just alluding to. And I know all of us in the funds on the stage have different perspectives on how to approach de-risking, but are all using different mechanisms to make sure that it's more than just capital. So I'm going to come to that one second, but who wants to take a fintech and climate stab? All right, Rachel, go for it.
Yeah, I'm happy to. I first want to just frame perspective around how we approach climate investing. So we see it in three different ways: planetary, human, and ecosystem. On the planetary side, of course, that focuses on mitigation. And at the end of the day, the biggest offenders of mitigation are not on this side of the world. So for the sakes of this conversation, we'll focus more on the human and resiliency and ecosystem piece. So for us, the human side of things relates to adaptation. It relates to how do you build resiliency for the populations that are most being impacted. And so fintech is clearly a tech-enabled solution in order to do that. We recently made an investment in Uganda in a company called Imata. They are essentially digitizing cooperatives, started in dairy, transitioning to export-oriented crops, and essentially helping farmers to build resiliency around deploying quick mobile payments to them to be able to afford inputs. So as we think about climate, I want to also broaden our thinking and broaden our definition around it's not just what's happening directly in the ground or directly in the sky or in the oceans, but at the end of the day, it is about people. And so fintech for us has been a really fantastic tool to tie this connection of how do we make sure from an adaptation lens we're investing in tools for folks to become more resilient.
Scott, I know you have a fintech at your heart. Any addition, any comments?
Yeah, well, I think fintech essentially permeates all the sectors that we're looking at from a climate resilience standpoint. And we're seeing it certainly most obviously probably in climate insurance, which is quite compelling, but we're also seeing it in supply chain financing, in forward contracts for nature-based solutions and carbon offset projects. We're seeing a lot of embedded finance, embedded credit that makes climate smart products more affordable. So it could be making a e-mobility solution or a renewable energy solution more affordable over time. So that could be solar irrigation, it could be a solar home system. Embedding credit into that certainly can lead to affordability, but in a lot of ways it can also lead to more resilient small businesses. It can lead to more adaptive supply chains that can weather shocks and stresses from a more extreme climate. Increasingly, we're also making the case that digital savings products can be bundled alongside a lot of these value-added information services, and that's another area where we're seeing small businesses be able to build essentially an emergency cushion, or families and households being able to do something similar. So yeah, I think in terms of fintech, it's what it can enable across all these different climate verticals that we're excited about.
Okay, thanks. Muthoni, anything to add on the fintech and how you all look at it?
Yeah, I think so. Some interesting models that we've seen, for example, is an e-mobility startup. So on the face of it, it looks like an e-mobility startup, but when you scratch the surface, it's really a fintech because they have a leasing model and they have a battery efficiency and charging system. So it's how do you, again, to Scott's point, is embedding finance within other business models, so that's interesting. We found, I mentioned about InsurTech, we have a startup in our portfolio called OCO. We invested in 2022, based out of Madagascar, that's working with cocoa, with cocoa manufacturers to really extend life insurance to smallholder farmers. So resiliency for us is a big deal because we see that you can wipe out an entire livelihood of a family if they don't have protection. It could be health insurance, life insurance, pension cover. And so models that really try to get that financial inclusion down to the grassroots are interesting to us, and we see scalability there as well.
Thank you. I'm going to jump a bit to de-risking. And I know I've done enough research to know that all the people on the stage have different approaches to it, or something, maybe some agree. So I want to start with you, Oliver, and how you specifically, and maybe Proparco also separately aligned, think about de-risking and value addition.
Yeah, I think we need, the two can't be decoupled, right? So what we're seeking as an institution is a balanced approach. Now, I was talking about some of the stuff we do in frontier markets. That for us requires concessional funding because ultimately you're working in an environment which is pretty complicated, right? That doesn't mean that the business models you're targeting shouldn't be fundamentally resilient. And what we're trying to do is, be a lot of the verticals I was describing. So initially, we did a load in pay-go solar, CNI, mini grids and metro grids. A lot of these were trailblazers. These were the first companies in the sector. We were confident that they had a sound model on an operating basis. And then our role was to just be additional geographically in those senses. And that's what we've been trying to do all along. It was interesting what Rachel was just saying about, when we're talking about mitigation, I think we need to have a broader sense of the development outcome of what we're trying to do here, and that's what we seek as an institution. You were saying that, we need to do a load of mitigation. There's no doubt about that. And when we're talking about adaptation, I think we as an institution have very strict criteria as to what that entails, right? But when we invest in Ghana, we invested in Complete Farmer, which is an agri-platform, which is basically just increasing the revenues of farmers, and it's increasing the yields of farmers. And in doing so, it's making them, the future is going to be, the climate-induced future is going to be harsh, and that's where it boils back to our core mandate, which is, we need businesses which work for the end users, so you avoid these questions of affordability when you're increasing their revenues. That's a sound business, and it also achieves what we're trying to do in terms of preparing, unfortunately, the future that's coming in terms of climate.
Well, Rachel, I was going to come to you next anyway, because I know being in many ways earlier, having grant and equity, there's different approaches that DRK can take. And on top of that, we've had a conversation around the different needs from a capital stack to actually start de-risking, especially early, but I think almost throughout the cycle, maybe up to at least Series B in a sense, depending on the business model, especially if it's deep climate tech. So I know I've had a few questions in there in that same statement, so I'm going to give it over to you.
No, I think you're absolutely right. And to Oliver's point, I think all of us on this stage represent a funding continuum in terms of stage and the types of instruments that we use. At DRK, we see ourselves at the very beginning of that funding continuum. So we fundamentally believe that we are there to de-risk some of these investments. First movers in the space, looking at climate investments in a different way. A concrete example around that is animal and vaccine health. That was not on a lot of people's radar as they were thinking about climate change. But there was a fantastic company out of Ghana called CowTribe who was working with this, integrating a tech solution. So to talk about the de-risking piece, I think we should be thinking about it as a funding continuum. And de-risking needs to happen at every single stage, from ideation to potential IPO. That means, are you looking at blended finance solutions? Are you looking at grants at various stages? It's really exciting to see that different investors and funders are actually seeing a lot of value and having a mixed cap table, rather than all VCs, all grant concessional makers, or all debt. So one, yes, de-risking is important across all stages. Two, we really see that as our key role in the funding continuum. And three, that's really needed in Africa from A to Z.
Thank you. Scott, I'm going to come to you down the line. Similar question, but also maybe a bit, do you see differences in what different models or different, let's say, sectors or subsectors need in terms of that, what Rachel's talking about, the stack,
absolutely.
right?
Yeah.
And then the second one is, what mechanisms along the continuum do you think are most valuable?
Yeah, well, I was actually just going to jump in anyway to
go
address that. So thank you for setting that up. But I think if we're going to close this massive climate adaptation funding gap, it is going to require coordination along, as Rachel was saying, all those different types of capital across the spectrum. So from concessional to catalytic to market rate capital. And to de-risk, I actually think we need to be able to actually lean into more risk, especially at the earliest and riskiest stages of innovation. So, to give you some examples of how we're approaching that, we have a family of funds and that goes across concessional, catalytic, and market rate investing. At the earliest stage, it can take an extra year or two, as we were hearing in the keynote, for climate entrepreneurs to be able to actually raise their first round of venture capital. And so what can we do at that design stage, at that R&D stage, to help build the evidence base around some of these cutting edge technologies and business model innovations? And so one thing that we're doing is we're using philanthropic capital to be able to pilot test alongside very early stage startups to prove out different technology areas. So AI and data analytics, regenerative agriculture. We're doing it across the spectrum with climate-proof housing. A lot of those areas that I think we're needing to seed a whole pipeline of solutions so that we can get to a point where later stage investors will have enough deal flow to invest in at the Series B and growth stages. We're also seeing that just agreeing about what makes up a climate adaptation and resilience solution is essential too. And so contributing to a climate adaptation and resilience framework around what measurement and impact. So one thing that we're doing is working with a group of peers to kind of agree on definitions and taxonomy so that we can work with climate entrepreneurs to help them strengthen the resilience of their user base, of their own supply chains, of their distribution networks, of their channel partners. I think that's another area where de-risking really comes in. And so the role of an investor can certainly be at the kind of due diligence phase to be able to do that climate assessment alongside the companies, but then taking it one step further and to be able to work with the startups so that they can build that sort of climate risk assessment into their own operating approach, so they can have an active impact management and measurement system so that they can calibrate and respond to a lot of the climate risks that they're facing at every level.
Cool, thank you. Muthoni, I'm going to come to you, and I know Katapult has had an accelerator to, I guess in a sense, de-risk, but also create pipeline. early on. So one, describe that. Do you think that has been valuable, and in what ways? And do you think, and I'm going to try to get some controversy going because we're all agreeing too much, and I wouldn't do my job. So do you think right now those mechanisms out there, we don't have to name names, are as precise as we need them moving forward, especially thinking about the types of models, the types of engagement we need to actually create that pipeline from A to Z and go into Series B+?
Yeah, good question. As I mentioned, we've been investing from the global perspective since 2017, so we are a family of funds. And what we have done across all the funds is invest at the pre-seed and seed stage level, and all our investee companies then go through our award-winning accelerator program, which is a 3-month program. It has 3 main verticals, one on impact, one on fundraising, and one on growth. So when we decided to come to have a dedicated Africa vertical in 2020, we brought that cookie cutter version of the program to the first cohort, and we got good feedback that it needed to be contextualized, especially when it pertains to growth on the growth vertical. So for the second fund, which was a Rwanda-based fund, we contextualized it to Africa. The growth module captures talent, government relations, scaling through mergers and acquisition. It talks about leadership, etc. So that was a very contextualized model, and we've had a good response from that 2022 cohort. We have 8.2 NPS, which means that when we talk to other founders now in our pipeline, we refer them to people who've already gone through the program as really advocates for the value that they see. So that's one way we've learned over the years that context really matters. When it comes to the value that they see, we've seen from our portfolio, I'll talk about the Africa portfolio, we've seen a leverage multiple of 15x. That means for every dollar that we invest, $15 have followed on. Which is a strong indicator that we're picking right companies, right business models, right founders, but also the work that we're doing post-investment is leading to growth as well. As I mentioned earlier as well, we have 2 unicorns in our portfolio. Both occurred under 5 years, actually under 3.5 years, and we've seen 4 successful exits as well. So all leading indicators towards the value that we create through our accelerator program. What we did do last year as well, we got some grant funding to pilot a pre-accelerator program. So this is essentially, we see strong deal flow. Last year we looked at 1,000 deals in Africa alone. And through the pre-accelerator program, we identified startups that are too early for us to invest in, but are really promising. And we ran them through that free program to really get them investor ready. So there's stuff that we're doing as well on the ecosystem front. And going forward, we have secured TA facility to really bring on scale-up coaches to work with our startups in a dedicated way to get them from seed to Series A, where we'll be able to double down. And I think at that point, they'll be really de-risked and able to scale and have broad-scale impact.
Thank you. So, what we've kind of talked about is a combination of an approach to try to balance the models we're all chasing. In a sense, we want to grow for adaptation, resilience, and that create products and services for that underserved mass market. And we believe that some of these mechanisms of de-risking, value addition, partnerships can make sure to create that foundation and parameters around them to be able to grow. And so I think I'll ask the easiest question before we open it for question and answers. How do you see that path leading to exits and VC exits in Africa? I think that's a question or a conversation that's been happening given how last year has gone and the capital markets where they are. And so trying to understand how you think about the models you've described or that are valuable to you or you're prioritizing, and then how the balances in those models in terms of what the returns you expect, and how that becomes a portfolio construction, and will it all be certain, just Series B exits if you're early stage? Do you think there's other, smaller cap PE exits? So trying to understand where really seek. So I think people can understand, especially founders, that what people are thinking about and how they may think about their cash flow and potential exits. Let me start with Oliver.
I think there's the reassuring thing is there seems to be more and more money being raised and going into this, right? So there should be a market for the kind of businesses we're building. I think what's, to Scott's point about getting the data right, I think that's really important because a lot can be called resilience or adaptation, and we're pretty strict in terms of the criteria we use, and a lot of what we do doesn't qualify. So you really need to, first of all, get the data to justify what you're doing, which will then unlock interest and value, hopefully, at the point of exit, and also what you need. By working with the companies and working with their users on these criteria of mitigation, I think you actually can build in, you're trying to actually enhance that. And then maybe there might be ways of monetizing that or not, but you are making more sound businesses fundamentally. And so that will be of great interest to us. I feel like you talk about exits, the companies we're targeting here, pre-Series A or whatever, they're quite a long way off. So this current environment hopefully will clear a bit by the time we need all collectively to realize our exits. But it's a problem we have less obviously because we tend to see ourselves as a multi-round investor. So we will accompany these businesses, and that's the role we will play. Even past the Series C, we'll have you have the PE teams coming in. You'll have more people looking at these as more businesses based on earnings and that kind of thing. But that's a long way off, and I feel like as long as there's a spectrum along the way and there aren't any gaps, then that's okay. And so what we really need to do is bridge the gaps and not leave any holes in the ecosystem. But it feels good right now, the panel we have here in that respect.
Cool, thank you. Scott, I'm going to jump to you, and then Rachel and Muthoni.
Yeah, so I feel like 10 years ago we were having a similar conversation around other sectors like fintech. And the best thing we can do as an ecosystem, I think, is just seed that early stage of innovation and try to produce as many climate tech startups as we possibly can. And over time, in the coming years, I think we can prove out, just like we did with fintech, like we did with logistics and distribution, that some of these models are going to be highly scalable. They'll be able to scale up to serve tens of millions, if not hundreds of millions of users, and become viable from a profitability standpoint, and exits will come as a result of that. And I'm very optimistic that climate tech in particular in Africa is going to be up there in terms of sectors that produce unicorns, that produce viable companies at scale, and ultimately produce exits for investors. But that's not our focus right now. As a very early stage investor, our focus is entirely on leaning into taking more risk to produce a much more vibrant pipeline of innovations that years from now, later stage investors can invest in, and eventually exits will come as a result of that, is just my point of view. So.
Muthoni, how are you thinking about this in terms of balancing that, leaning in and creating pipeline, like you said, using accelerators or pre-accelerators, but also trying to ensure that there's financial viability for the fund?
Yeah, so fundamentally with our model, what we're saying is we will go out there and find the best early stage startups. And from our own portfolio, we're creating our own deal pipeline for later stage investing. So I think from a macro level, we think about it from what is a growing, what is a large and growing market as part of the fund thesis. So we settled on climate and ag. And then from an instrument perspective, if you're thinking about exits, it really depends on what you're investing in. So if it's debt and revenue-based financing loans, then those are self-liquidating, and the exit sort of speaks for itself. As an early stage investor, we see the most natural exit opportunity to be secondaries. But we do expect there to be more M&A. When we look broadly at our global portfolio, especially the one in Latin America and Southeast Asia, we've seen a lot more M&A from those emerging markets. So we expect over the next 10 years or so that there'll be a lot more M&A activity in this space as well. When it comes to protections as a minority shareholder, obviously having protections in there, having conversations, actually we found with founders at the outset that we want to be in their company for no more than 6 years, starts them thinking around what exit opportunities that would be. As part of our fundraising module, we simulate what fundraising would look like given different instruments, different growth projections. So they're already thinking about their cap table, how to bring in multi-stage funders as part of their cap table, thinking about when to leverage debt instead of equity. So we already have those conversations with our startups. And then as part of post the program, for example, we have an AI and data analytics team that helps them find mentors globally that will support them on their growth, but also enables them to expand their search for investors that will be useful. So bringing tech tools to support with their fundraising journey and their growth journey is something else that we do.
Great, thank you. Rachel, going to give you the last word. I know it's a bit of different approach for DRK, given capital preservation is kind of the focus. And then we'll take some question and answers.
Yeah, it's a bit of a different approach, but I think the takeaways are relevant across the spectrum. And I just want to elevate something Muthoni said around context matters. And every single person on this stage right now is either working with a fund or organization that didn't originate on the continent. And a lot of why the funding winter has deeply impacted this ecosystem is because there have been imported expectations around what growth needs to look like, around what an exit needs to look like, around what scale needs to look like. And one thing that we take very seriously is not only localizing our support on the ground, especially in the African context, but we really see our role as an ecosystem crusader to encourage our peer investors, if they don't already have people on the ground to understand, then they absolutely need to do that. And I think the takeaway for founders is ignore the Silicon Valley path and definition of what scale and exit needs to look like. I think the vision for exits in Africa is going to be highly localized, to Muthoni's point and to Oliver's point, likely through M&As, which are already happening, often quietly. So I think the closing point for me around exits is let's make sure we're crafting the definition and expectations around exits that work for this context and are not being imported from other places.
Thank you. That's a fantastic point to end on. I'm going to open it up. I think we have a few minutes for question and answer. I think they'll bring you a mic, or your voice may be loud enough, but
Hi, really great panel. Thank you for your time, everyone. My name's Lewis Good. I'm the CEO and founder of AfriVest. We're solving for the funding gap that a lot of African startups face here, the $140 billion funding gap through equity crowdfunding. So we look to connect Africans, so those in the diaspora and in Africa, to connect and invest in African ideas. My questions are really around investment and support. So as you guys have talked sort of like very diligently to the support that some of these climate tech startups need, you talked about a variety of sort of tools and methods. But I'm going to maybe ask a bit of a difficult question and say if you only had like one of these initiatives that you're going to roll out in terms of how you're going to support the startups from mainly sort of pre-seed and seed is where my sort of focus lies. What's those sort of initiatives like?
I'm James.
Sorry, I don't know if somebody's shouting. What would that sort of be one initiative, that silver bullet, that one thing that you double down and focus on to make sure that your startups are growing and having the impact that they can do for their smallholder farmers, for the environment, for the stakeholders that they work with? That's my question. I did have everything, but I'm aware of time.
I think it was a bit hard to hear. Would that be correct for the panel?
The question was post-investment support.
I think it was post-investment support, and you said maybe the one thing that mattered the most? Pre-seed to seed. Would that be correct?
Yeah.
All right, we got a thumbs up.
Yeah.
So pre-seed to seed, post-investment support, the one thing you would hammer home for a founder. Who wants to take that?
Governance.
The one they love the most, Rachel. Every time we have that conversation, my founders come back and say, I love that you mentioned that. Sorry for the star people. Muthoni? Your one word?
Get revenue proof points.
Scott?
I would say data and feedback loops around the customer experience, so that you can, even if you're not a profitable company yet, you can prove that you're having an impact on your customers, that there is product market fit and positive unit economics at a certain level that could become profitable someday.
Oliver?
I'd say business model fit. which I'd like to see more of if possible.
Okay. Any other questions? I think we may have time for one more before we get kicked out. There's something in the back, or someone in the back. Sorry, N1 here, sorry.
Yes, hi. My name is Michael Nimo. I'm with Spout International. We are the largest ceramic water filter manufacturer in Africa. So from what you've been talking about, I've been hearing lots of high-level tech. What about investment in sort of low-tech products and services that are also making an impact and also reducing our carbon emissions? Any interest in such ventures?
Yeah, go ahead. I think someone's going to say something.
I could tell, well, we do.
Yeah.
We do asset-heavy, non very tech-enabled businesses, but there needs to be a very strong climate angle for it to be viable for us on the VC side. So, and that is a proved climate impact if it's going to be in terms of adaptation here.
Yeah, same with us. It doesn't always have to be deep or high tech. For us, it needs to be a scalable business model. That's really what we're looking for. So concrete example, we invested in a business here in Kenya around affordable housing, where they're basically using refabricated, more climate smart materials. So not your typical tech solution, but we are helping them look at ways to integrate tech to make their operations more efficient. So our vision is for scale, not necessarily tech for tech alone.
Are we squeezing in one more? All right.
Hi everyone, thank you for this panel speech. My name is Maxim Makarchuk. I am Chief Operating Officer for Gigi. We run the largest classifieds platform in West Africa. We are present in 5 countries. Thank you for your discussion today. My question is, can you share your view on the most lucrative business opportunities around carbon credits, and where do you see the most potential in this field? Thank you.
Well, I'm not sure it's the most lucrative, but one area that I'm really interested in is in forward contracts and financing for small and medium-sized project developers. I think that's a wide open space that as soon as carbon credit markets become more viable, scale to a certain size, to be able to democratize access to carbon credit markets is going to require more access to capital at smaller scales up front for project developers, and it's also going to require lower barriers to entry in terms of certification. And so a lot of the solutions that we're investing in are kind of helping enable both those things, both the upfront certification, compliance, as well as the financing.
Anyone else want to talk carbon markets? No, I think, all right, on that note, thank you all very much for coming and participating. Thank you to our panelists for the vibrant discussion. And if there's many more follow-ups, please find us afterwards, and we're going to have more discussions afterward. Thank you.
Wonderful. Can we have a big round of applause for this wonderful